Hi, I'm Peter Andresen with Andresen & Associates, and I'm here to discuss the financial markets during the first half of 2024. I'm standing here with my feet in the river, the Big Sur River, at the Big Sur River Inn in July. Still mighty chill, which is good because we all need to chill right now. The thing is, it's like the movie Sideways. If you saw the movie Sideways, which was a 2003 movie, mostly I remember Paul Giamatti, but Sandra Oh and I think Thomas Hayden Church was also in it. It's about a wine critic who has an emotional meltdown, and he screams that he's not going to drink any more blankety-blank Merlot, and he seeks out Pinot Noir. And the result of that was that although from 2003 until now, grape production has gone up 8%, Merlot has collapsed about 70%, and Pinot Noir has gone up 170%. And that's pretty much the story of the first half of 2024. A lot of your investments, when you look at your investment return, went down. Interest rates did not go down. Our long bonds surprisingly suffered some very mild, minor, almost non-existent losses. Small stocks, not up. Basically gold went up because they keep thinking interest rates will go down, and the S&P 500 went up because of AI. Right now, the Pinot Noir flavor of the month is AI. Let's get back to the office and take a closer look. Well, we're back in the office. All things being considered, I'd prefer the Big Sur River, but here we are. So check out this graph. This is from December 2021. This is measuring from the time that the Federal Reserve began to raise interest rates, essentially. Before that, remember we went through COVID in, let's say, 2020 and 2021. We went through a period of time when the expectation was that interest rates would never rise again and inflation would never be a problem. And as inflation began to emerge in 2021, remember that the Federal Reserve's first reaction for a long time was that it's transitory, it's just caused by the pandemic, it's not going to be a problem. Eventually, when they decided that it was going to be a problem, they raised interest rates. Now, that was a shock to the whole system. Treasury bonds are supposed to be safer than stocks. They're supposed to eventually provide less volatility than stocks, but that's not what has happened since December 2021. Treasury bonds have been all over the place. Let's go through the graph one step at a time. Start at the top with the green line, that's gold. The interesting thing about gold is it's a sterile fixed asset. It doesn't change into anything else. So when you buy a gold ETF, if it's really gold, not gold miners, it's just gold. So it's a pure measure of the expectation of recession and civil unrest, basically. And what it is high. It's outperformed the stock market since December 2021 because of expectations that a recession is going to happen because of that inverted yield curve. It occurs to me that the Treasury bond performance and the gold performance cannot both be right. Now, there's a leftover mythology from the 1970s that gold is an inflation play, and it has been, hasn't it? So it correlates, but more than that, it's a measure of how much investors think there will be civil unrest because it detaches one's money from the dollar. A note about gold, it can be quite volatile. It hasn't really been during this time frame. And to get your profits, you have to sell because within the ETF itself, there is no moderation whatsoever. You got a pure play by the tail right there. The next line is the yellow line. That's the S&P 500. Now, the interesting thing about the S&P 500 is that it's a shape shifter. It changes, and it's changed rather nicely. Right now, the Magnificent Seven, that's, let's see, I'll read this. NVIDIA, Microsoft, Apple, Amazon, Meta, which used to be called Facebook, Alphabet, which used to be called Google, and Tesla. That is, all the tech darlings that are in favor right now, that are overvalued as sin right now, they're now 31% of the index. So what that means is if you've got $100,000 of the S&P 500, you already own $31,000 of this. So if people say, hey, do I own any NVIDIA? And I'll tell them, yeah, you sure do if you got an index fund. Now, unlike gold, it's a shapeshifter. So it will change based on, because the index automatically does that, based on market conditions. It'll also get utterly, completely, deeply slammed if it's overvalued. Not permanently, but if you own the S&P 500, you should be prepared for some volatility. The blue line is First Eagle Global. The point here being that a lot of internationals have not done badly since this time, mostly because of their ownership of gold mines and commodities. So international, which is half the valuation of the S&P 500, has actually not been a bad place to have money. It hasn't performed as well as the S&P 500, but it hasn't been bad. Then we've got the Vanguard S&P Small Cap 600 ETF. That's interesting because it's a proxy for small stocks. Small stocks do two things. Historically, over the long term, they outperform, historically. They haven't in the last decade, but historically, they outperform the S&P 500 because smaller companies are capable of a greater percentage of growth. How's that? The other thing is, they croak during recessions. So the danger here, and the reason why you've seen small stocks, which again are half the valuation of the S&P. S&P is overvalued. I'll get into that later. But the reason why you've seen this little purple line going sideways, even in the last 3 months, slightly negative, is that people are waiting for that recession. They're waiting for that other shoe to drop. And they could be wrong. It could be we don't have a recession. I'll get into that. Now, when we began this in December 2021, I was nervous about the 0% interest rate. I didn't trust that. So we did not own long treasuries, which historically have been quite sedate, like 1/4 of the risk of the stock market. But they were yielding 0. And the old caveat is that yield to maturity is usually an indication of total return. So 0% equals 0%. So we were in the orange line. We were in the Schwab Aggregated Bond Index, which is a much shorter maturity, and shorter maturity funds like that. And guess what? When interest rates went down, or excuse me, I correct myself. When interest rates went up suddenly and sharply, one of the sharpest, in terms of magnitude, one of the sharpest increases in history, we had literally the worst bond market in history, especially on the long bonds. So we got tagged a bit. We got tagged a little bit. It wasn't pretty at all. And the frustrating part is that the bargain, the big bargain, right now, the big bargain, if you look at the numbers, if you look at the statistics, is in that blue line at the bottom, the long-term U.S. Treasury. Because if we have any kind of slowdown, which is what the Federal Reserve needs to drop interest rates, that's what everybody's banking on. Everybody's betting the farm on dropping those interest rates. If the Federal Reserve drops interest rates, the capital gains in the long Treasury bond are going to be as equity sized. They're going to be quite epic. They'll be one time only because, like gold, long-term treasuries are long-term treasuries. They're vanilla. It's what you see is what you get. Again, like gold, the way to get that capital in is going to be to sell them. But right now, that hasn't happened. That's very, very frustrating for me. That's epically frustrating because the big trade, the big genius trade that is supposed to eventually make money in the last 3 months has actually gone down a little bit. So that's frustrating. Okay. Valuation. What would motivate us to stay low risk, why don't we put it all into the S&P 500? Just put it all in there and capture this market. Let's take a look. Okay, why are we invested like this? Let's take a look at this graph. This is the Shiller PE. That means it's the price divided by the average of the past 10 years' earnings for the S&P 500 in this case. The Shiller PE is the Rodney Dangerfield of variables. What that says is, as a statistic, it can tell us when we're overvalued, and historically that very much correlates to future returns. That's very much the case. It's been quite accurate. The downside is it doesn't get any respect like Rodney Dangerfield because it can go on for years in an overvalued state. However, when it corrects, it tends to correct in a very emphatic way. It tends to, as you can see on the graph, it tends to go back towards the average fairly energetically, and that leads to carnage. Now, in this case, if you look at it, most of the gain of the last 6 months has been made in the top 7 stocks or top 10 stocks. The remaining 490 stocks of the S&P 500 hardly have mattered. In fact, in the last 3 months, they did negative 0.80%. So they mildly lost money. So what that's telling us is that the overvaluation in the stock market is mostly focused on tech. So like 2000, the year 2000, this is likely if we have a correction. I mean, we might not. According to the Shiller PE, we're going to have one. It might take years to get there, but we're going to have one. When that happens, it's more likely to be contained into the tech sector like the year 2000, unless we have a recession simultaneously. And that's my concern. Now, this thing's going to go on, in my opinion, until everybody is satiated with AI, until earnings actually physically drop on NVIDIA, they actually drop on the accompanying stocks. Until earnings actually take a hit, this thing's going to continue. But let me put yourself in my shoes. What am I going to do with that statistic? Do I buy into it and hope I can dodge that bullet when it finally happens? Or do I try to keep you safe? Because remember, my first job is to keep you rich, not make you richer. Although I like to make you richer. That makes me happy and it makes you happy. But the first goal is not to create carnage. And if I'm looking right at the statistic, what am I supposed to do? You might give me a call and let me know what you think I should do in your portfolio. Oh, but there's one more variable. Let me show you that. Take a look at this graph. Oh yeah, I know. You're gonna, here we go again, Pete with the yield curve, beating that drum. However, historically, inverted yield curves, which we've had since 2022, indicate to us that a recession is going to happen. That indicator has been incredibly accurate until now. Now it's not doing so well. Now, what I mean is, as an indicator, it's not doing very well. But check this graph out. This is the date of the inversion, and on the vertical axis, it's time in months until a recession happened. In other words, a recession happens months after the yield curve inverts. Now, again, put yourself in my shoes. Here's the question. Are we looking at a recession that has been delayed? Or are we looking at a recession that simply isn't going to happen? Please call me and give me your opinion. Because historically, we're more likely than not to just have had a recession that was delayed. Now, the French CAC 40 was down about 8% in the last 3 months because of political unrest. Political unrest tends to lead to times of economic challenge temporarily. Are we going to see that? It's not permanent. But is that going to be what kicks us into a recession? I don't know. But I'm looking at those two statistics. I'm looking at the Shiller PE, and I'm looking at that inverted yield curve, and I'm saying this is the time for caution. Again, keeping in mind that if either of those things are correct, the big trade is going to be in the Treasury bond market, in which case we'll all look like geniuses and we can all go hang out in the Big Sur River. Please let me know what you think. I'm staying patient. It's a challenge. I'm frustrated. Enjoy summer and blessings.